The main function of the manager is the activity of the business. Manager need to know whether the activity is up to mark or not. The activity ratios are very important for any business. I'm Dr. Safdar Hussain Tahir, postdoc UWA Business School, the University of Western Australia, Associate Professor, Lalpur Business School, Government College, University, Faisalabad. So we need to discuss the activity ratios. The activity ratios are: number one is receivable turnover ratios, and then payable turnover ratio, inventory turnover ratios, and then total asset turnovers. Look at the balance sheet again. Current assets, fixed assets, current liabilities, long-term liabilities, and owner's equity. Students should fix the minds that the balance sheet have a five big component. And where is the activity of this business is functioning? Certainly, that there is the activity of the business. Business purchase raw material and convert into a work in process, finished goods, sales, account receivables, and then cash. This is the activity. So this ratio belongs to the current assets where the activity of the business is performing. The first one is receivable turnover, annual net credit sales over receivable. And BW December 31st, 2023, the activity ratio is 5.61. It indicates the quality of receivable and how successful the firm is in its collection. We can calculate from this ratio average collection period. 365, the total number of days of a year divided by 5.61 is equal to 65 days. It means that the sales converting into cash or receivables converting into cash in 65 days. Average number of days that receivables are outstanding is 65. You can compare this ratio again with the industry. The industry ratio is 65.7 and your ratio is 65 days. It means you bit better than that of your industry. The second thing is the payable turnover. It is annual credit purchase divided by account payable. BW have a this ratio 16.5. It indicates the promptness of payment to supplier by the firm. And it is also been converted into average day of your payables. That is 22.1 average number of days that payables are outstanding. You can compare your payable turnover with the industry payable turnover. You are well ahead of the industry and you pay in 22 days about while the industry pay in 47 days. BW has improved the payable turnover in days. Is this good? You must seek that you receive about 65 days and you pay in 20 days. It may create some mess in future and future you may short of cash. Then we have our inventory turnover, cost of goods sold divided by inventory. And its ratio for BW is 2.30. It indicates that the effectiveness of the inventory management practices of the firm. You can also compare this ratio with the industry. Your ratio 2.3 while the industry ratio is 3.45. BW has a poor inventory turnover ratio. It means you are taking more time to convert into inventory into finished goods or either the finished good inventory into sale. And the last one is the total asset turnover, that is net sales over total asset. BW has this 1.02, indicate the overall effectiveness of the firm's in utilization its asset to generate sale. It means that your $1 generating $1.02 sales, and your dollar is, this is your total assets performance. You can compare it with the industry. The industry average is 1.17 while your is 1.02. BW has a weak total asset turnover ratio. Why is this ratio considered weak? Because industry is industry ratio is 1.17, which is well ahead than that of BW. BW must look on the marketing strategies or on the their finished good product and work in process, which are taking more times. Thank you so much for your watching this video.